the quarter wasn't great, but we said the stock should have traded a lot worse than it did. And if you remember, I think it got down to, I want to say 281 or so. It was only down $4 on the day. Since then, it's rallied. It's a valuation thing. I mean, these stocks, in terms of historically where they've been, they're actually cheap compared to themselves and probably trading a market multiple now. So the fact that they've come off so much, I don't think the quarters were as disastrous as people were anticipating, which is why these stocks go up. Lowe's has been in a sort of this range 185 to 225 for a while. We're going to get towards the upper end of the range, but Home Depot, I think, acquitted itself pretty well last week.
In the spectrum of retailers, is home improvement more defensive, Karen, in this environment?
Than discretionary, than lower end discretionary?
Than a Target, than a Nordstrom, than any other retailer out there. I mean, is there something to be said for people bought these homes and they've got to do something with it?
There's some amount of maintenance work that regardless of whether
that they will fix the roof, they will retile, they will regrout, whatever it is.
I think so. I think that, well, their PEs reflect the expectation that they will have a more steady business going forward than a retailer, which has a lower PE multiple. So I own both Lowe's and Home Depot. I'm comfortable owning them, but I wouldn't be surprised if they trade a little lower, a little higher. If you're right, if housing slows, they'll trade a little lower. But long term, this is low, as the guy said, PE, and it's lower than the market now.
Yeah.
I think we got to go back to what Rebecca just said about like the lag effect. And I know we talk about this a lot, and we just haven't seen it in a while because we haven't seen a rate hike cycle like this. But think about this. Housing makes up between 15 and 20% of U.S. GDP, right? And so we just talked about 30-year fixed mortgage rates at like 7.5% or something like that. Every car dealership right now has too many cars on their lots. But you don't want to buy a new car right now because you don't want to finance it at that sort of rate, right? And so, like, think about this. It's like, yes, your wages might be a little higher, but we've seen a lot of white-collar jobs be cut over the last few months or so. I just feel like that if there's any softness anywhere, like if you start to see this dynamic, this supply-demand dynamic, just soften because of rates, I just feel like there's a lot of pockets of strength right now. Energy was one of them last year, you know what I mean? Then it's starting to kind of fall off a little bit. I just feel like that, like the foundations for the economy are not that solid when you consider that rates are not going down anytime soon unless something really bad happens in the next 6 to 9 months.
I mean, the thing that's holding us up now is that when we talk about wages and people's ability to buy a home or buy the stuff to improve their home, 80% of the jobs in the United States are service sector jobs. And manufacturing is in a recession. We saw that in latest PMI's business sentiment surveys, but the service sector is still doing pretty well. And so as long as that one holds in and those jobs don't get lost, I think they will. I think it's coming, but we're not there yet, which is why I'm not that surprised to see the numbers from Toll Brothers and Home Depot. Like, we're still okay because the service sector is so strong, but that's the next shoe to drop, I think.